The state of the current real estate market here in America has high interest rate, high home values, and low inventory. Sounds horrible for buyers and good for sellers, right? Well, for sellers in certain highly appreciated market, they also have something very real to worry about when selling their homes for a lot of money, and that is the capital gain tax. Everybody, Bojie He here, your local Bay Area real estate agent and expert. Welcome back to my channel, and today we are diving into this critical topic for homeowners and potential sellers: the rising tide of home values and the surprising stink of capital gain tax, which I think is one of the contributing factors to the current low inventory. Now, did you know that a recent CoreLogic report reveals a shocking increase in home sales triggering tax liability? Stick around to discover why more and more homeowners are facing these hefty taxes and what it means for the future of the housing market. Also, if you are considering selling your highly appreciated assets but fear for capital gain tax, what are all the solutions that could help you eliminate or defer your taxes? So make sure you watch this video to the end. Now, before we start, don't forget to hit that like button and subscribe for more insights and updates. Now, let's get into it. As you may have noticed, home values across America have skyrocketed in recent years, especially during COVID. While it is a good news for property owners to see their homes are worth more now, however, you cannot just materialize all your gains, because selling your home could come with an unpleasant surprise: the capital gain tax. Now, since 1997, if you make less than $500,000 in profit from selling your primary homes as a joint owner, like a couple, you were off the hook for the federal capital gain taxes. This tax rule, known as the Section 121 exclusion, was designed to ease the burden on homeowners, but it hasn't changed in over 2 decades. Back then, only a few homes appreciated enough in value to cross the $500,000 threshold. But times have changed. According to the recent CoreLogic report, a staggering 229,600 homes sold last year had profits exceeding $500,000, potentially triggering a hefty tax bill. This is a sharp increase from just 1.3% of sales 20 years ago to 7.9% sales today. So why are so many more homeowners are getting hit with these taxes? It boils down to two main reasons. First, home prices have surged drastically over the years. And second, the capital gain exemption limit hasn't kept up with the inflation. So if adjusted for today's dollar, that $500,000 cap would be nearly $985,000. That would spare many from unexpected tax wounds. This outdated limit is pushing many homeowners, especially older Americans, to rethink selling. They're choosing to stay put altogether, rather than facing a tax hit that will wipe out a significant portion of their profit and their retirement. In some cases, they're opting to hold on to their homes until they pass, allowing their heirs to inherit the property at its current market value, called the step-up cost, avoiding those capital gain taxes altogether. Recently, a proposed legislation called More Homes on the Market Act, introduced by U.S. Representative Jimmy Panetta, aims to modernize these limits, offering relief and encouraging more homeowners to sell. Panetta's bill proposed raising the capital gain exclusion limit to $500,000 for single filers and $1 million for joint tax filers, with regular future adjustments for inflation so that it would be aligned with other tax provisions that already frequently adjust for inflation, like the standard deduction and income tax credit. This change could open up the market, making it easier for homeowners to sell and for home buyers to find homes. But until these reforms are passed, many homeowners are stuck between a rock and a hard place, facing tough decisions about their financial futures. So where are homes appreciated the most and have to face the most capital gain tax? According to CoreLogic's report, the following states have the highest share of home sales that have more than $500,000 appreciation when they sell. Number one, California, with 28.8% of all homes sales here have triggered capital gain tax, even after applying the $500,000 Section 121 exclusion amount. Number two, Hawaii, 23.8%. Number three, Washington, D.C., 22.1%. Number four, Massachusetts, 17.9%. And number five, Washington State, 15.2%. New York, Colorado, and New Jersey are also having double-digit shares as well. Most of these homes that appreciated for more than $500,000 belong to downsizers or long-time landlords because they have owned homes long enough to accumulate such appreciation in those specific market. Now, for these homeowners, selling their highly appreciated home in an expensive area and moving to a cheaper area for retirement is a common thing to do. Now, having enough money to live happily through their retirement year is perhaps the biggest concern that they will have. Capital gain tax would take away as much as 40% of their profit when selling their real estate. And here's the breakdown. The federal tax is somewhere between 15% to 20% depending on your income bracket. In the state of California, there's another 13% approximately as ordinary income tax. Then there is a 3.8% ACA or Obamacare tax that you may or may not have to pay, plus the depreciation recapture that varies. This could be as much as 40% in total. So after all these years of hard work and owning the property, paying for the property taxes, home repairs, maintenance, and now the property finally appreciates, yet you're on the hook for another big tax bill. That isn't a good news. So, if you are considering selling your highly appreciated real property and have concerns for huge capital gain tax bills, what are some options? Traditionally, for highly appreciated primary homes, the Section 121 exclusion as part of the Taxpayers Relief Act implemented in 1997 was good enough of a solution because based on prices in the 90s, most of the homes did not appreciate for more than $500,000 when selling, and most homeowners would not be worried about capital gain tax after applying the exclusion amount. Now, since Section 121 exclusions only applies to primary homes, when selling rental properties, homeowners would typically use 1031 exchange as a way to defer their capital gain tax. However, as time goes by, both tools are not working as well as before. As we previously mentioned, because of the inflation over time and the highly appreciated home prices, the current Section 121 exclusion limit is still based on the 90s number, which is not enough anymore. The current status of the proposed legislation, More Homes on the Market Act, is still being introduced. We still don't know when and what will happen, if anything happens at all. Now, in the case of selling investment properties, due to the low inventory and extreme sellers market that we have, the chances of finding a replacement home in 45 days become a lot more challenging. Also, for people that want to sell because they want to retire from landlord business, it just wouldn't make much sense to sell and buy another property at equal or higher price just to defer the capital gain tax. For these reasons, a lot of homeowners decide to just keep their properties and pass them on to their heirs to reset the cost base with a step up in value. Not a bad strategy. And this is also one of the contributing factor to low housing inventory that we have today. Now, if you do want to sell, but neither Section 121 exclusion nor 1031 exchange will help you with your desired capital gain tax solution, don't worry. There's another strategy that may just be what you're looking for. It's based on tax code 453 installment sales, but done in a much more efficient way, which not only allow you to defer all your taxes, but also give you much greater control of the overall process and the situation. Moreover, the strategy works with all assets, including primary homes, rental properties, and even the sale of a business with profit. Therefore, I have made another video that goes in much greater detail on how this strategy works. And it's not for everybody, but if you have a large amount of tax liability, you may want to look into that video in my channel, link in the description. So, if you are thinking about selling your home and wanting to know more in detail about what tax deferral or exemption options you may have, I would encourage you, of course, to consult with tax professionals, but also for any real estate related questions, feel free to reach out to me and I would love to help or point you in the right direction. My contact information is in the description. Anyways, if you like this type of content, please like and subscribe, and I will see you on the next video.